Hi everyone, welcome to Share Club, our regular meeting at Simply Wall Street where we talk about stocks and investing. My name's Sasha. This is the second in a series of little lessons that we're going to do about investing. The first one that we did last time, if you remember, was around risk profiling. And now this one, we're going to actually have a look at some business models. So we're going to look at some different companies and have a talk about, what they do and how their business model looks and how you would think about that as an investor. Okay, so before we go ahead, please have a look at this important disclaimer. Obviously, none of this in here is advice. We're not taking into account any of your objectives or financial situation. And very importantly, down the bottom, the presenters may hold securities in the companies being discussed. So just bear that in mind if you do see any information about companies in here, which you will. All right, so today's agenda, we're going to start off just by having a look at a business model. We're going to have a bit of a group task after that, where we're going to split up into different groups, assess a company's business model, and come back and present that to everyone, which will be about a 1-minute presentation each. Don't worry too much. It's not going to be that difficult, hopefully. After we come back, we're just going to have a bit of a look into what does a good business model look like, what we're interested in when we're trying to find a company. And we're going to split back into our groups and do another little task on our company where we have a look at how attractive or robust the business model actually is, which we'll then present back to the group again. And we'll just finish off with a bit of a Q&A if anyone's got any questions. Okay, so let's kick it off. To start off with, what is a business model? So essentially, that's the core strategy of the company that they're using to make a profit. So within a business model, we want to identify what type of products or services are they selling, what's their addressable market, and also what are their costs of doing business. Probably the easiest place to find information on a business model is if you have a look at a company's annual report. So I've just put this 10K form up from Apple as an example. In the table of contents, you'll see the very first item is business. If you click on that hyperlink, it should take you to a description of their business, which will talk about their business model. So some of the questions that you might want to ask yourself as an investor about a business model is, how does the company actually generate revenue? What are its products and services? Who are its main customers? And also, you want to have a think about what actually needs to happen for a company to generate revenue. So for example, if I'm thinking about an oil and gas company, well, I want people to use a lot of oil products. So I want maybe more cars on the road. Not that that's a good thing, but if I was to invest in one, that's what I'm expecting to happen as one of the drivers. Another thing is, what's the company's cost structure? Are they online only? Are they brick and mortar? Are they combination? Are most of their costs fixed or are they variable? How about the company's gross and operating margins? Are they pretty small or are they really wide? And also, is the company or the industry the company's in capital intensive or is it capital light? So that means, how much cash do they need to hold for, everyday purposes, or how much cash do they need to invest to actually run their business? And the third thing you might want to think about is, how does it make a profit and what is its strategy? Is it trying to compete on price or is it trying to deliver quality products that, people go to because they're high quality or they seem like good value? And also, do they typically spend big on marketing or have they already built up a pretty strong brand where they don't need to do that as much? One thing that new investors definitely don't think about a lot, but is very important to do, is when you look at a company, don't just look at the sector or the industry that it's in on face value. You really want to drill down and find out what its actual revenue sources are. So you might want to see what segments they operate in and which ones of those bring in the most revenue. Also, what are the drivers of revenue? So that goes back to what I was talking about before with the oil and gas company example. You need to know what makes customers want or need to buy more or less of this company's product. Thematics are also very important as well to think about. Does the company benefit from any broader economic trends like aging population, globalization, working from home trend, etc.? So some good examples here. These are all Aussie market examples, but we'll be talking about companies in the States as well later on. I've given 3 examples here. Iris, for starters, is a company that's typically been put in the tech sector, but when you actually think about it, it's a market data provider, and most of its economic drivers have to do with how many financial firms there are in the country, how much people are trading shares. So should that actually be in the finance sector? It was at one stage, and then it's flip-flopped according to S&P's categorizations. Another example is REA Group, which is an online real estate classifieds. This is actually classified by S&P as a communications company, but really, should it be a real estate company? Should it be a tech company? Most of their product revolves around their online app and how popular that is and the network effect that they've generated, along with the fact that they've got the best technology behind that app compared to their competitors. So maybe that should be a tech company, I don't know. And thirdly, we've got Amphole, which is formerly Caltex. It's just a petrol station operator in Australia. It's actually in the energy sector, but maybe it should be a consumer stock, because we know that they don't actually produce all that much in terms of oil and gas products now, not like they used to anyway. They're now generally just resellers of fuel and also sellers of convenience products through their convenience stores at each petrol station location. So maybe it's not actually an energy company, because the drivers of other energy companies might not be the same as Amphole's. So that was a pretty short overview. We're going to go into our first group task now. So what we're going to do now is each group's going to receive a company to look at. And at this point in time, we don't have to go too far in depth. I just want each company to have a think about, each group to have a think about how the business model works for the company that they're looking at. So how do they generate revenue, who their customers are, and how they actually plan to make a profit. Annual reports are probably the best place to find this, but you can also have a look on the company's website in their about sections. They might have a bit of information about that too. Once we're done, we'll have 15 minutes for this, by the way. Once we're done, each group's just going to come back and we'll have about a minute to present what we found. Next thing we're going to talk about is we've had a look at the business model of our company, and at a high level at least, we've had a look at where they generate money, what some of their costs are, and perhaps who their main customers are. One other thing that's really good to look at is there's a lot of frameworks out there for understanding competitive advantages. And, at the end of the day, that's what we're really interested in when we're investors. Most literature that you read from some of the best investors in the world, a lot of them talk about things like competitive advantage, something that sets a company apart from its peers and allows it to generate consistently high profits. So I want to show you guys one really common framework that's used, and that's the Porter's 5 forces. So this is actually a model that was developed by an academic called Michael Porter in the 70s, and it's mainly used to determine a competitive environment within an industry, but it can also be used, at the company level, and it tells you a little bit about its ability to generate strong profits because of competitive advantages. So the 5 forces that Michael Porter uses in his model are, Number one, barriers to entry. Number two, bargaining power of buyers. Number three, bargaining power of suppliers. Four is the threat of substitutes. And the fifth one is competitive rivalry. So they're the five forces. So I think some of these slides are actually out of order. I don't know what's happened there, but let's just go on to this one. So the first one we talked about was barriers to entry. Now, when we think about barriers to entry, what we're talking about is what is going to make it easier or harder for other competitors to come into the market. The harder it is for a competitor to come in a company's market, then the more likely they're going to be able to create large profits. So when we think of barriers, a type of barrier is economies of scale, capital intensity, infrastructure requirements like Disney had, for example, and government regulations or licensing. So when either of those four things, are pretty high for a particular company, it means that generally speaking, it's hard for other competitors to come in and try and take a piece of the pie in their market. The second point was the bargaining power of buyers and consumers. So for a company, if their buyers of their product are large or concentrated, that can generally be a bad thing for their profits, because that means that, if I'm a company and 20% of my revenue comes from one customer, then that customer has a lot of, weight when it comes to negotiating contracts next time around that comes. So we might have to lower our price to them because we don't want to lose them. It's such a big part of their business. On the flip side, if you have lots of smaller consumers, like a supermarket, for example, where your customers are just the general public, then you have a lot more power there, and that increases your ability to make profits. Switching costs are another thing. Are there other products out there, but switching to those is really difficult or will cost you a lot of money. The higher that is, the more likely you are to make profits. And also product homogeneity. So if you're selling a product that everyone else has, then you're less likely to be able to make large profits. But if your product's very unique and difficult to replicate, then that's going to be in your benefit. All right, the third point was bargaining power of suppliers. So it's very similar to bargaining power of buyers, but this is people who are supplying your company with raw materials or whatever you use to provide your services or products. So once again, if your suppliers are large or concentrated, that can be bad for your profits because you can't really negotiate that much with them on price. Switching costs, again, same thing. Product homogeneity, very similar to the buyer's one. And the other one is if you're in an industry where suppliers can threaten vertical integration, which means if it wouldn't be too difficult for one of your suppliers to go, oh, you know what, instead of me supplying you with raw materials, I'm actually going to build my own factory and start making your product. That's also bad for the competitive environment for your business, right? And it can be an actual threat. The fourth point was the threat of substitutes. So if a product that you sell is easily substituted with another, that's going to be bad for profits in the long run because people can just switch and not really notice the difference. Perceived product differentiation is another thing. So that's where your brand or your perceived higher quality might be something that can help you make long-term profits. And also, if you have any sort of technological advantage or there's regulation or intellectual property that protects the sale of your products or services, that's also a really good thing. And just finally, competitive rivalry. Obviously, if there's a high concentration of competitors, which means there's fewer large businesses in your industry, they're more likely to be able to generate long-term profits. Whereas if there's a lot of very small companies, then it's a lot more difficult to do because no one really has any sort of power. Brand loyalty is another thing, and obviously network effects as well. All right, so let's have a look at a couple of different types of industry structures. These are basically economic principles. So you probably would have seen these in the past as well, but we're going to give a few examples and explain why these are important to think about when you're looking at a particular business. So monopolies are firms where there might be one company where they're the sole seller of a particular type of product or service, and there's no close substitutes because there's significant barriers to entry for other competitors. And some of those barriers, like we mentioned, they could be legal, they could be economic or regulatory or even geographic. And when there's an unregulated monopoly, that can actually mean they have significant market power and influence prices. So some really good examples of these are Transurban. For those who don't live in Sydney or Melbourne or Brisbane, Transurban is a large toll road operator. They pretty much control most of the toll roads that encircle those cities, which means they have a monopoly on that type of service, and they can effectively charge what they want, although they are slightly regulated, so they can't just go crazy, but there's no competition for them. Another one is Sydney Airport. There's only one airport in the city, so they're the only ones that are going to get any airport traffic, and they can essentially charge higher than they would if there was competition. Google Search is another one for obvious reasons. Microsoft as well. Microsoft's software suite for a very long time was pretty much the only thing that people used, along with some other smaller competitors. That's changing a bit now. And probably the best example, unfortunately, these guys aren't a listed company, but Luxottica. If you own a pair of sunglasses, there's an 80 to 90% chance it's actually made by Luxottica. They're by far and away the largest producer of sunglasses in the entire world. And you might not realize it, but your Ray-Bans and all these other popular brands are actually owned by these guys. So it's just one company that makes everyone's sunnies that people wear around, except maybe the cheapo service station ones, maybe not those ones. All right, so the next type of company or industry structure is oligopoly. So this is the next step down, where it's a market structure where there's just a few firms that dominate, and it's usually highly concentrated among those firms. There's usually some smaller companies that operate in that particular market, but they just follow what the leaders are doing, and they usually don't make very large profits compared to them. So some really good examples are big four banks in Australia. They control virtually 80 to 90% of the home lending market. So they can set the prices wherever they want, and people, because of loyalty or whatever else, they tend to keep going back to them. A really good example is telecommunications. If you do a deep dive into telco industries worldwide, you'll find that there's no single country where there's more than 3 or 4 major telecommunications providers. And the reason why is there's so much infrastructure that's required to serve a really good telco network that no more than about 4 companies can survive and make a profit. And that's a really interesting case study because it holds worldwide. Samsung and Apple as well, they have some other competition coming through now that's joining them, but in the mobile phone market, they essentially dominate. And another example, which is a bit of a local one to Australia, but I'm assuming would be similar in other markets, is outdoor advertising. Because outdoor advertisers have to buy up all these billboards and infrastructure assets to show ads to people, that lends itself to a network effect, because they can say, I've got all these different locations in different cities that I can advertise your product to their customers. Whereas, if there's a smaller competitor, they just might have one billboard somewhere in a not too interesting location. And if I'm a customer that's trying to market a product, I'm going to go, well, you know, you're not really going to get my product or my ad to as many eyes as these bigger guys, so I'm probably going to go with them. So that's another really good example. And all of these examples lend themselves to, you know, companies making profits and having sustainable competitive advantages. At the other end of the spectrum, we also need to keep an eye out for companies with commoditized products or commoditized services. So these are, you know, when you think of commodities, obviously there's hard commodities like oil and gas and metals, that sort of stuff, and also agri-commodities, but there's actually a lot of different types of products that are commoditized, and they're essentially things that there's not much product differentiation no matter who you buy these things from. So I don't know, like lately with COVID, obviously there's hand sanitizer, you know, that's a commoditized product because it all serves the same purpose, and all you're doing is just picking a brand off the shelf for whatever reason. There's probably no strong reason why you're doing it other than price. So they're relatively indistinguishable from the same offerings presented by a rival company, and they're only distinguished by their prices, as I said. And because of that, these products typically lack distinguishing features, and there's very little to no profit margins. So like I said, resources is a very good example. Fresh produce and agri-commodities is another, and utility resellers face this problem as well. If you're, you know, looking for an electricity provider, you know, I'm not too worried about what brand of electricity I'm getting. It all does the same job. So I'm probably going to look at who's going to give me the best price. Does anyone have any questions at this point before I go ahead about those different structures and Porter's 5 forces? I think we're okay. All right, I'll continue on. So we've talked about a few different aspects that we want to look at when we're assessing a business, and also some examples of, you know, really strong businesses and also perhaps a weaker type of business structure. But let's dive a little bit further into what makes a good business model, or, you know, what types of things are we looking for when we're thinking of sustainable competitive advantages. So I've got a list of about 7 things here that I'm going to go through. First one is network effects. So this is when the effect of increased numbers of people or participants in a network improve the value of the good or the service. The good thing about that is it makes it really difficult for anyone else to break through, because they're not going to be able to provide that same value as someone who's already built out a network. So very good examples of that are Facebook, for obvious reasons, REA Group, which is that real estate app that I told you about. You know, they generate, or they don't generate, they command about 90% of people who are looking for real estate. So agents are more likely to go on there and put ads because they know more people are going to look at it. And similarly for Xero, which is an accounting software provider, they have a network effect because there's so many accounting firms that now use that software, and because of that, a lot of financial planners are starting to use that as well, so they can integrate their own clients' accounts into Xero, and that creates a network effect as well. Next idea is high brand equity. So companies that have products that are memorable, easily recognizable, or superior in quality or reliability tend to have high brand equity. And that means customers are willing to pay a high price for their products, even though they can, you know, get the same thing from a competitor for less. So, you know, Nike, Lululemon, Apple, Louis Vuitton, these are considered to be premium products in their own segment. So people tend to pay more for their products because they want that higher quality, or they want to buy that brand because it's memorable or easily recognizable. And this is a way that companies can generate sustainable profits. Another way is to be a lowest cost producer or to have scale effects. So any company that has a really big scale advantage can usually provide a product or a service at a lower cost than their competitors, and typically more efficiently as well. So if you think about the really big miners or supermarkets like Woolworths and Coles that have this really efficient supply chain infrastructure, it just makes them a lot, it makes it a lot cheaper for them to deliver the products that they do to their customers. And that gives them a really big advantage over other competitors who are trying to get into that same market. Okay, next point is novel technology or intellectual property. So any company that has products that are covered by intellectual property rights have those products protected from production without consent. And that makes it really difficult for rivals to actually provide a substitute or a competing product in that case. So, that goes for pretty much any biotech company, technology companies in general, any things like Apple and Microsoft, a lot of those services or products that they provide are protected in some way, and that makes it difficult to replicate for other companies. Difficult to replicate is the next point as well. So companies that have spent, years and large amounts of capital building supply chains or infrastructure make it really difficult for rivals to compete with them. So, Amazon's a really good example. They've got, so many warehouses and distribution hubs globally that they have spent years and years investing in so that they can deliver products as, the quickest to anyone and also at the cheapest price. Another good example is APA Group, which is an Australian company that is pretty dominant in the gas pipeline market. And, as you can see from the map on that screen, they have pipelines that cover, the whole country, and these things are like thousands of kilometers long. So just imagine if you wanted to get a slice of that market, like you're going to have to spend years and years and billions of dollars building these gas pipelines. It's probably just not going to happen because it's going to take you too long to get into that market. Second last one that I've got is geographic location. So this is a really good one as well. If you are a company that's locked up a certain advantageous area or region with infrastructure or assets that allow you to deliver products or services faster or more efficiently, or meet a need that another location doesn't allow for, then that's going to be a huge advantage for your company. One of the companies that I really like that fits into this is Goodman Group. They're an industrial real estate company, and they've done a really good job of building all of their industrial assets right in the middle of a whole bunch of gateway cities and hubs where there's a lot of demand due to e-commerce, mainly for warehousing space or specialized warehousing. And a lot of that demand is actually from Amazon and companies like DHL and that. And because they've built up a portfolio where they've taken all this inner city real estate, if you have a look around Sydney, there's not many places where you can stick a warehouse at the moment. And it's actually a large reason why Amazon is struggling. Amazon is struggling so much in Australia, because they're finding it really difficult to build up the network that they need to provide their products as efficiently as they do in other countries, just because the land is not there for them to acquire at the moment. And another really good example is Cube Logistics. They own ports and also infrastructure, supply chain infrastructure hubs around Australia. And, they've locked up a lot of really good locations and ports around the country. And, you can't just say, I'm going to build another port. The government's not going to allow that. So if you don't have access or control of a port in a major city, then that means you're not going to be able to compete in that market. And just finally, this one's a little bit less common, but it's really important because there are companies that have the advantage of licensing. So licensing requirements are the ability to provide some products or services that can depend on, usually very expensive, very long-term and exclusive licensing arrangements with governments or regulators. And without a license, you can't actually operate in some markets. And probably the best example of this is lotteries. Lotteries are one of the best sort of just stable income, stable profit generating businesses that there are globally. But the thing about it is, at least in Australia and pretty much every other country, you need to have a license to operate a lottery. And most countries still have government owned and operated lotteries just because it is such a good profit generator. But in Australia, there's one company that controls most of the state lotteries, and that's Tabcorp, and that's been a huge advantage for them. And on the flip side, wagering and gambling is also one of those industries where you generally sign like 20, 30-year licenses to provide gambling services. And, they also happen to have that as well. That hasn't been as attractive of a business for them, but the lottery side really is. And, people like Tabcorp a lot just because of that. Okay, does anyone have any questions about those before I move on? Nope. Okay, cool. So they're all the good things, and then I'm not gonna just keep going on about all the bad things as well, but I just wanted to give you one example of a bit of a business model trap. And this is when you have a look at a company and things look really good, but there's just something not quite right, and it can be a bit of a risk. And this is really important to think about when you're an investor. And one example that I like to bring out is Blackmores, which is a bit of a polarizing company. If you don't know too much about it, it's an Australian vitamin and supplement company. And over the last 10 years or so, it's been a pretty massive beneficiary of Chinese consumer demand for premium quality and safe Australian products. And it's really enjoyed significant brand power in China. And because of that, they're generating really strong revenue growth. They're very popular. People, they've got a lot of high profile sort of promoters over there, and the stock has just been going nuts for a very long time. But one thing that investors usually overlooked when they bought the stock several years ago when it was going crazy is there's three issues with Blackmores. They didn't actually own any of their manufacturing facilities. Their product is commoditized. Essentially vitamins are all the same. They're all the same active ingredients, no matter which company you buy them from. And they pretty much relied entirely on their reputation for quality and safe products to, build the brand equity that they did. And if you don't know, pretty much all of the production costs that go into producing vitamin products are in the packaging. The actual vitamin tablets themselves are something like 1% of the cost, I think, last time I checked, because all of those ingredients are really cheap. So all you're really paying for when you go to the shop and you pay your $50 for your tub of vitamins, for 100 tablets or whatever it is you're just basically paying for the container and the brand, nothing else, because the vitamins are worth nothing. So the problem with all of those three things is, if you can imagine, these guys don't own the manufacturing, they don't really have control over the supply chain, yet one faulty batch of their vitamins from an external supplier could effectively damage their reputation and kill off their business, because the whole reason Chinese consumers were so into Blackmores is because of that, reputation for safe and high quality products. So this is not to say that they won't continue to make profits. The share price has definitely come off a lot since it went crazy. Like it went to over $200 at one point. I think it's now like around 80 something. So it's come off entirely, but these are just the types of things we want you to think about when you're investing, so that you know that even though it might look great on the outside, you need to think about, well, what are the potential pitfalls? Why could this be a disaster later on? And, they rely on their brand so much, but as Chris Hemsworth says here, you might actually feel better on Swiss anyway. So people might start moving over to them instead if something goes wrong with Blackmores. Okay, so I think that's enough of people listening to me babble on here. We're going to go back into our groups now. So with the same groups and the same companies that we looked at before, the next thing I want everyone to think about is whether the company you're looking at has any competitive advantages. And when you think about that, try and use the Porter's 5 forces framework to help justify your decision. So, those 5 things were the competitive environment, how much competition there is for your company, what's the power of buyers, what's the power of suppliers, are there any valid substitutes, and also are there like any barriers to entry to going into the industry that your company is in. So use that framework as a guide, and the other things we talked about. I wanted to say, just be critical. Every company will tell you a really good story in their 10K or their annual report. They're very good salespeople, but it's your job as an investor to sort out the trash from the treasure. So be critical. Don't just take everything at face value that they say. So yeah, we'll go back into our groups and we'll present for 1 minute each again when we come back. To say I'm really impressed with everyone's work. You all sound like experienced equity analysts, and you definitely picked up on things that I would want to pick up on. So that was really great to hear. And I hope that was really helpful for everyone, just to get yourself in that investor mindset to think about, what are the threats for my company? What advantages do they have? And some teams look like they've made a decision out of their research, which is really great. That's what we want.